Okay, Matt Orton is Chief Market Strategist at Raymond James Investment. He's joining us right now to take that the market in the US is kind of waiting in wait and watch because of all of the large earnings and more. And then you got some inflation data later this week, and then the Fed decides next week. Matt, what's the least path of resistance for markets?
Hey, Prashant. Weeks, U.S. equity have essentially gone no place. They didn't really go any place today. Expect going forward unless we see really strong upside from the mega cap. We likely tread water again. You know, markets are trading towards the upper end of their range. I wouldn't be surprised of weakness, especially if results are mediocre or just hit expectations. Guidance isn't that exciting from some of the names that report. So in the absence of any really positive news, I think markets trade sideways to down. And frankly, the biggest risk I've been talking about with clients on U.S. equities is the Fed, and it's this disconnect that the market has between where its pricing rate cuts and where the Fed is likely to go. I fully expect us to get a 25 basis point hike next week at the May meeting, and the Fed to emphasize that higher for longer really means higher for longer. And so when you look at the trade and technology so far this year, and particularly the mega caps that have contributed about 80% of the market gains to the S&P 500, a lot of that is predicated on rate cuts. And so to me, it makes sense to be defensive. Don't chase the market higher, lean into quality, and there's going to be better opportunities, but right now is not the time to be waiting in.
Okay, so expect a 25 basis points rate hike at the next Fed meeting. Better to be defensive and stay a bit cautious. Matt, hi, good morning. Is that your view on the Indian markets as well? Because the tide is turning here, or at least that's the narrative. The worst of the fall perhaps could be behind us because we're getting good quality earnings, especially from leading sectors like banks. Your thoughts?
Yeah, good morning, Sonia. And it's not the case for India. You know, India has been an area I liked in emerging markets last year. I've been a little bit reticent towards India over the past couple of months, but I like the constructive price action. I like the fact that we're starting to see more positive earnings momentum and good results. And banks have been an area that I've liked for a while. And I think with India, the fact that the trend of higher lows remains intact, I think that's very encouraging. I think the one challenge to Indian equities is going to be IT services. You know, Infosys didn't do any help when they reported earnings last week, but barring that, I think there's a lot of positives for the overall market. And so I'm encouraged by the price action in India, and so I am changing my tune there.
All right. And Matt, just to reconfirm, I think the last time we chatted as well, you said India gets preference over China. So do you hold on to that view? And also, I think you'd also briefly mentioned that maybe the weakness in IT services could be a good entry opportunity. Were Infosys numbers too bad now? Would you change your stance? So I wanted your view.
Hey, Nigel, good to see you. And I certainly prefer India over China. That's definitely been consistent. I still prefer emerging Asia over India, so countries like Indonesia, the Philippines, Taiwan, South Korea, but it's marginal. India is certainly growing because a lot of those Asian countries have appreciated. They've done very well this year, and particularly the leverage to semiconductors. I think a lot of that's more fully priced in. So it's a marginal preference, but if the price action in India can remain constructive, I think I'll probably move India up to the top. So we'll see over the next week how earnings play out in the Indian market. And within IT services, I mean, the results for Infosys just weren't good. But I think when you look at it as a whole, they weren't surprisingly disappointing. I think the biggest challenge, and it speaks to the broader industry as a whole, is that the concerns, the economic concerns around the rest of the world are going to be a challenge, particularly in asset management and financial services to which the company is levered. So in the near term, I think it might be a little bit too early to be bottom fishing in IT services, but I would say medium term. So after the next quarter, hopefully we can see the earnings cycle start to bottom. And as a lot of these companies start to cost cut, I mean, they've been investing in growth for the past couple of years. As you start to see cost cuts come in, demand rebound in the developed world, especially as wage inflation continues to be an issue, I think you're going to see earnings change as well.
Okay, so you're saying that it's too early to perhaps bottom fish in the IT space. That's because there is no clarity on earnings. What about banks? Before we let you go, is that a big yes from you, especially the likes of ICICI Bank? I mean, you know, we've got some stellar numbers coming through.
We do, and so I wouldn't even say we're bottom fishing in banks because they've done well relative to the rest of the market. And I think banks continue to look attractive. It's encouraging because when you look at the opportunity in financials in India and really other emerging markets relative to the US and Europe, there's a much more positive backdrop. And I think within Indian banks in particular, the backdrop of solid ROE, expanding loan books, net interest margin, all of that is encouraging, and I think that can be kept up. So when you add the guidance that we've received from companies that have already reported, I think that's a space that you want to continue to be invested in. And if you're not invested there, I would consider getting in because I think the strength is going to continue.
All right, Matt, we leave it there. It's a pleasure, as always, speaking with you and having you with us here on the program today. Thank you. Matt Orton at Raymond James Investment Management. Well, we'll take a very quick commercial break here. Our list of top stocks to watch lined up next with